Hi, Charles Sizemore here. So you might have noticed the market is getting a bit choppy. It's up as I'm recording this video, but I could blink my eyes and it could be down again. It's definitely been a rough, week and a half here. So what's going on? Should we panic? Is this the beginning of the end of the bull market? Is this just a bump in the road? What's going on here? Before we get into that, I would just point out that how soon we forget, how quickly we forget. It was just a little over a year ago that we were in full panic mode. The world was ending. The stock market was crashing. It was the worst volatility by some measures in the history of the stock market. And quickly that extreme fear gave way to extreme greed. We had a monster year in the stock market in 2020, even the beginning of 2021 here. Stuff for the record books, right? That's how the pendulum can swing. It goes from extreme fear, to extreme greed, back to extreme fear. And what we're seeing now, I think partly because the market has been so supercharged. This has not been a normal bull market over the last year. This has been something extraordinary. Partly, I can't just say partly, largely driven by Fed stimulus, by government stimulus. This is not a normal market. And so I think there's this fear that everybody knows that this market where, tech stocks exploded, you had weird IPOs and this SPAC formation happening every other week, the cryptocurrency thing where no one even knew what Bitcoin was a few years ago. Now there's, a gajillion different coins and they all seem to go up hundreds of percent in a week and then crash. People know that this is not a normal market. They can feel that. And so I think that makes them a little bit more uneasy. Every down day suddenly seems a bit more scary because we're all afraid that this last year of extraordinary gains is about to come to an end. Like this experience of the last year was not normal and not long-term in nature. Maybe. But I would say let's kind of step back for a minute and kind of look at the bigger picture. For one, corrections are normal. And what we're in right now isn't even a full-blown correction. The S&P 500, I think from recent peak to recent trough, it was down roughly 5%. The NASDAQ was down 7 or 8, but it didn't even get to that 10% mark. We didn't even get the formal correction. In order for it to be technically a correction, it has to be a 10% reduction. We didn't hit that. We may still, we don't know if this is over, but as of now, this isn't even a formal correction. It's just a hiccup. I mean, that's not a technical term. You won't hear Adam talk about a hiccup from his chartered market technician work, but that's what I would call it. It's a pause. It's a slight hiccup. These are normal. Even full-blown corrections are normal. They happen, a correction or something close to it happens almost every year. Out of the last 20 years, we've had 11 in which there was a decline of at least 10%. We've had a couple other years where the decline was just shy of 10%. It was almost there. It was a near correction. If you just kind of lump those in, at this point, significantly more years than not have some sort of correction. I mean, even in a raging bull market, you do have corrections. You have people take profits. The stock prices get ahead of themselves. You look at your brokerage account and you see these huge gains. You want to take a little money off the table. So do all your neighbors. It's normal. The market does not go straight up. If the market went straight up, there would be no risk. And if there was no risk, there would be no return. Look at the risk-free rate right now. The risk-free rate is the government bond rate. That's effectively zero going out several years. So that's just it. I mean, like these bends and twists we see, they are normal. So all of that said, I could make that same statement right before a bear market, and that's a different deal. Bear markets are less common, but they happen pretty regularly. We had the S&P 500 lost nearly half its value in the 2000-2002 bear market. In the 2008 blow up, the S&P 500 actually lost more than half its value. In the 2020 coronavirus bear market, the S&P 500 lost 30 something percent there. So, these are much more jarring. You can recover very quickly from a 10% loss. If you lose 10% of your portfolio, that's not really going to blow up your retirement. If you lose half, that's a different story. Over the last couple bear markets, we've recovered fairly quickly, but that may not be the case for the next one. And even recovering, even if it takes a few years to recover, that might be a really big deal if you're retiring today or if you're already retired. So we don't know ahead of time if this volatility we're seeing today is a garden variety correction and it's no big deal, it's just part of the market, or if this is the start of something worse. All bear markets start out as garden variety corrections before they slide into a bear market. So I'll say right up front that I don't think we're on the cusp of a bear market, at least not yet. The Fed's still throwing everything they have at this market. I feel like until that slows down, this bull market will continue. Now, of course, it could be that some of this turbulence we see in the market is the market handicapping the Fed backing off. That's possible. We won't know until after the fact. But I would say, kind of as baseline, I don't really think this is at the beginning of a bear market, but who knows? It could be. So how do we navigate that? Like what do you do in that situation? So the first bit of advice I would give, this is actually a trader's maxim. It's not really, you're not going to read this in a financial planning book. It's more of trader talk, but sell to the sleeping point. If you're nervous, if you really can't relax, if you're getting heartburn because of the market volatility, you're taking too much risk. It's that simple. You should reduce your risk holdings. You should reduce your stock market holdings until you're at a point where you're comfortable. If that's zero, then that's zero for you. That means get out of the market completely. If you're completely comfortable with this volatility, you have years or decades until retirement. Maybe you have other sources of income from rental properties or something. I don't know. I don't know what your situation is, but let's say you're very comfortable with these market gyrations, then maybe you stay fully invested 100%. That's fine. It really comes down to you. It comes down to what your immediate liquidity needs are. It comes down to how close you are to retirement. It comes down to your well-being, at what level you feel good taking risk. If you're a risk taker and you like having money in the market, by all means do it, just so long as you can afford to take that risk. If it's causing you distress, then at a bare minimum, sell off some, sell off half, whatever that number is for you, but sell to that sleeping point, sell to that point where you can relax. Now, beyond that, you get into, okay, so first off, that's the macro portfolio allocation. How much should you have in stocks in general? It's going to vary from person to person. And a lot of it has to do with your age and how close you are to retirement. But ultimately, you sell to that sleeping point. But beyond that, how do you further reduce risk? So the best way to make sure, how do I put this? The best stock you could imagine, just like whatever your biggest success story was, the best way to turn a great investment into a potential bomb is to simply own too much of it. Because remember, you and I, we're not Warren Buffett. No one's inviting us to sit at the board of directors. No one's inviting us to, come to the company. That they're not giving us the accounting books to read. We're outside investors. We're passive outside investors who we read the same material that's available to the general public, and we have to make decisions based on that. That's the information we have. We don't have that inside information, and we certainly don't have the ability to influence the company. We're too small to do that. So it doesn't make sense for you or me to take some massive outsized position in a company the way someone like Warren Buffett would. When Warren Buffett does that, management invites him into the room to talk, like he's part of the crew at that point. If you and I put 100% of our portfolio in some stock, whatever, Amazon, Apple, we're still going to be too small to be taken seriously by the company. It is what it is. So it doesn't make sense for us to, like, we gain nothing by taking a huge position in a company. We just add a lot of risk. So the best way to make sure that you can sleep at night and that you don't blow yourself up in a market rout is just don't have too much in a single stock. There's a million, not a million, but there's thousands of good companies out there to choose from. You don't have to put all your eggs in one basket. Now, what does that mean in real numbers? For me, a typical stock shouldn't be more than about 3 to 5% of your, on initiation, that position shouldn't be bigger than about 3 to 5% of your portfolio. Now, if the stock explodes higher, it doubles and, it becomes 10, 15, whatever percent of your portfolio because it grew. Well, that's a high quality problem to have. At that point, you do have to consider tax implications or whatever else in selling. But I'm talking about at initiation, like at the beginning of the trade, it shouldn't be more than about 3 to 5% of your portfolio. I don't care if it's, a big company like a Microsoft or Johnson & Johnson, whatever, 3 to 5% is about as high as you should go on that. As a case in point, I've been ragging on AT&T lately. AT&T really screwed up. They overpaid for Time Warner's media assets, and then the deal didn't quite go as they planned. They're stuck with a lot of debt. 3 years after they made the deal, they're already trying to unwind it. Well, the stock is in free fall. Nobody wants to touch it right now. People are questioning management's competence. Imagine if you had 20, 25% of your portfolio in that stock thinking, oh, well, the dividend's good. Maybe I should just load up on the stock. You'd really be in trouble right now. So, keeping your position sizes kind of that 3 to 5% window there, that's good. That keeps you out of trouble. Now, I said that's a good number for a normal stock, like a large cap mainstream stock. If you're looking at things that are more speculative, I think you do have to take that number down a little. If you're looking at some, micro cap, marijuana stock or something, 1% of your portfolio is pretty aggressive for something like that. You really do not want to put a lot at risk on a stock like that. Same with cryptocurrency. I have a little bit of Bitcoin. I have a little bit of Ethereum. I'm just kind of playing with them, kicking the tires, if you will. I consider those speculative positions. Maybe they do well, maybe they don't, but they're not a significant part of my portfolio at all. They're a very, very, very small part of my portfolio. Now, on the other end of that, like let's say you're sticking with ETFs or mutual funds or whatnot. In that case, you can go bigger. If you're talking about an S&P 500 index fund or ETF or whatever, you can put obviously vastly more than 3 to 5% of your portfolio in that. I mean, if you're running a 60-40 portfolio, 60% stocks, 40% bonds, which is sort of the standard in the industry, then 60% of your portfolio could be in an S&P 500 index fund. Like that's not reckless. That's actually pretty normal, so long as it's appropriate for your age or whatnot. But so it really comes down to that position size, and you do have to ask yourself, what am I buying? Am I buying a boring, conservative, dividend paying, stodgy old dividend payer? Well, okay, 5% of your portfolio for that stock is fine. If I'm buying an up and coming tech stock that might go up thousands of percent or might go to zero, you might want to go on the lower end of that scale. 1% to 3%. But be smart about it. You feel like a rock star when you win, but that joy you feel from winning, that rush you get from a winning trade, that's not as powerful as the gut punch you feel from a losing trade. We hate, human beings, as the psychologists have discovered, hate losing about twice as much as they like winning. And it's just our conservative nature. It is what it is. So anyway, long story short, the best way if we are going into a correction here, if we are going into a bear market, the best way to protect yourself from the get-go is just don't have concentrated positions. Just have, be smart about your position sizing. Next point I would make on that is you also want to, whenever you enter a stock position, you should always know when and how you're going to exit it. If the stock does extraordinarily well, do you have a price target? In some cases, I see some investors that they'll put a price target. If they hit that price target, they might sell half, take some profits, and then let the rest run. That's fine. If that's your game plan, just stick to it. You do have to worry about downside protection, though. If you have, if you buy a stock and it doesn't work out, and let's be clear, not every stock you buy works out. Even Warren Buffett has some real bombs from time to time. Under what conditions do you cut your loss? Stop losses are not a panacea. They're not perfect, but they are good for instilling that discipline. So if you have a stop loss, and whatever that is, 7%, 20%, whatever that number is, and I would recommend, adjusting your stop loss based on the performance of the stock. You can do it the old school way. You can look at a stock chart and kind of point it to support levels. If it penetrates those, that's your stop. You can use something more quantitative. There's a million ways to skin that cat, but the point is, you should know under what conditions I get out. Even Warren Buffett, to our knowledge, doesn't use stop losses, but he has rules. If he loses, he has criteria for when he'll exit a stock. And for example, last year during the pandemic, he got out of all of his airlines. He said, look, my rationale for buying these, like the conditions that were in place when I bought these, are different now. It's a different world. My reasoning no longer makes sense. I have to be objective. I'm selling. Warren Buffett is a robot. He has that kind of discipline. For the rest of us that don't necessarily have that kind of discipline, and we try to rationalize our trades, it's better to be more mathematical about it. Just pick a number. If the stock price penetrates this level, I'm out, or I sell half, or whatever your rule is, but have a rule and stick to it. Even if you have a rule that may not be optimal, a suboptimal rule is better than no rule at all, because at least it instills discipline. So again, you want to protect yourself from whatever may be coming. Have some stop losses. Go through your portfolio right now. Go through every stock in your portfolio, if you have not done this already, and ask yourself, when would I want to sell? Look at a stock chart. Look at whatever. Just ask yourself the question on each of these stocks: at what point would I sell? Write it down and do it. Like, stick to that plan. It may not come to it. This little mini correction we're in right now may already be over. But by the time you watch this, who knows? It may be over. But you should be doing that anyway. And these corrections are always a nice kind of gut check to make us do these little things that sometimes we get lazy and complacent and don't do when stocks are going straight up. So that's basically it for this week. Like I said, I don't really feel like this little market volatility we're experiencing right now is the beginning of something big. I think it's a garden variety little bump in the road here and nothing else. But it is a good opportunity for us to just revisit risk management, revisit, what is our overall allocation to stocks in general, and is that appropriate for us? Is it causing us stress, or should we reduce it? Within our individual positions, are we overweight any of them? Should we sell them down to a reasonable size? And once we're in these positions, under what conditions do we leave? These are the questions you have to ask yourself. If you take the time to do that, you'll be fine. You'll get through this. I can't promise you won't take any losses. There's always a potential for loss in the stock market. But if you take these basic steps to protect yourself, you won't take catastrophic losses. This will keep you out of trouble. So that's going to wrap it up for this week. We'll pick this up next week.